Hi, this is Kevin from Excel Coaching. In this series of managerial accounting, we'll explain the different cost types in a business and use our understanding of costs to explain the concept of break-even analysis. Fixed and variable costs are incredibly useful in examining the relationship between cost, volume, and profits. Fixed costs are fixed in nature, that is, irrespective of a level of production, the cost is the same. Think of the rent you pay for your business as an example. Variable costs are costs which directly change with the level of production. That is, the more you produce, the more the cost you incur. Think of material costs as an example. There are some costs which don't fit in 100% in the category of fixed or variable. We refer to them as mixed costs. An example would be your utilities bill, whereby you may have a fixed component and a per consumption rate as well. Understanding your costs allows you to undertake insightful analysis, such as a break-even analysis. Break-even is an important managerial accounting concept. The break-even point is defined as the volume at which total revenues equals total costs. So you got your total revenue here, total revenue line, and your total cost line. The point they meet is that break-even point. This is important to understand as it tells you the level of production you can target to make a certain level of profit. Once you understand this important concept, you can do lots of simple analysis that yields some pretty powerful results. Now that we understand what the break-even point is, let's figure out how we calculate it. To illustrate this, we use an example of ABC Private Limited, where we are given the price to be $100 per unit. So the sales price per unit is $100. We are given that the variable cost is $40 per unit. And we are given that the fixed cost is $24,000. These are the financial information we'll be using to calculate the break-even point. So, step 1, we identify what the fixed costs are. In this example, we are looking at $24,000. Step 2, we calculate the contribution margin. The contribution margin is essentially the sales price minus the unit variable costs. In this example, it is $100 minus $40. Therefore, the contribution margin is $60 per unit. The last step, step 3, is fixed costs divided by the contribution margin. Therefore, it's $24,000 divided by $60 gives us 400. So the break-even point is 400 units. Now that we have calculated the break-even point to be 400 units, how do we interpret this? We'll use a graph to explain some of these points. As you can see, the red line crosses a pink line at 400 units. This is where the total costs and total revenue matches, that is, the break-even point. Any production above this level, the company makes a profit. See the yellow line. Beyond 400 units, it shows a positive number, that is, a profit. Conversely, any production less than 400 units, the company makes a loss. As you can see, the break-even analysis is quite powerful to understand the level of production a company must target to make a profit. Thank you for watching our recording on break-even analysis. Trust you have enjoyed it. Feel free to reach out should you wish to learn more about these concepts or discuss something in particular about your business or a cost challenge you are facing. If you like our recordings, please do subscribe to our channel. with the subscribe button underneath the recording or by clicking on the Excel coaching logo. Thank you. Until next time.